This is the Lulich Corner. I'm Jordan Lulich, and today I've got the opportunity to sit down with Brian Denton with Cardinal Financial. Brian, thank you so much for coming in, taking the time to sit down and talk a little bit about lending and mortgage. It's a crazy time right now, so I'm excited about today's conversation. Before we dive in and start talking about mortgage and interest rates and everything, what's going on, why don't you tell us a little bit about yourself as well about Cardinal Financial?
All right, great. Thanks for having me, Jordan, by the way. I really appreciate the opportunity. I've been in the mortgage business. I hate to say it. It'll be my 40th year in this February.
Okay, congratulations.
Thank you. And I'm still living to talk about it, which is excellent.
That's awesome. So you've seen a lot in the last 40 years.
I got out of the Air Force in 1984 and went basically straight into the mortgage business and worked on all areas. I was a loan processor, a mortgage underwriter, and then became a loan officer.
Okay.
I owned my own company and sold it in 2006, and then the company I sold it to promptly went out of business during the credit crunch of 2008.
Okay.
So I went to work for Fairway and then stayed there most of my career and ended up back with Cardinal. So Cardinal's a national company listed in all 50 states, and I'm really enjoying my experience here so far.
Good. Well, let's dive right into it. So, Brian, what's the difference? Let's talk about lending, right?
Okay.
And let's talk about financing. So, in financing, there's so many different aspects of financing a purchase, right? You've got closing costs and down payment and interest rate and loan application and loan approval and a contract and financing contingencies. But let's really take it down to the basics and talk about what is a down payment and what are closing costs, and is the down payment, are closing costs included in your down payment?
Right. The short answer on that question is no. So down payment is separate. So you can put as little as 3% down in some programs, all the way up to as much as you want to put down.
Okay.
So in closing costs are based on loan amount and what the cost of title insurance is and title fees and all that, plus our origination costs as well. So that's totally separate.
Okay.
And they generally run about 3% of the sales price. I mean the loan amount. So that's a good rule of thumb if you're trying to plan.
So if you've got a loan where you have to put down 20%, then you need to plan on putting down 20% plus closing costs.
Correct.
Or 3% plus closing cost, or whatever the amount of the down payment's required. Yeah. You got to plan for an addition for closing costs.
Yes, additional assets. So,
that could be overlooked pretty easily, because I could understand why people would think that it's included, because 20% is a lot, or 3% could be a lot depending upon the amount.
Yeah.
But it's an additional cost that you got to plan for.
Yeah, and that's why it's important to sit down with a qualified loan officer,
right,
whether it's me or somebody else.
Right.
We're blessed in this area that we have a lot of good loan officers in our area. So,
absolutely.
And it's always great to do business with somebody locally.
Absolutely. I mean, you can't beat the opportunity to see them out in Publix or a grocery store or a restaurant and be able to face them. And hold them accountable. Yeah. You didn't answer my call, or you did this, or you don't get that when people are out of town. So correct. I always shop local if you've got the opportunity to do so.
Perfect.
So and especially when I was younger, I had the conception that in order to purchase a home, you have to put down 20%. Right? That's the baseline minimum. If you don't have 20% of the purchase price, don't even bother trying to purchase a home.
Yeah.
So is that still true today?
No. There's programs where you can get down payment assistance if you qualify. There's also, you can mostly, the lowest down payment is 3 to 5%. So,
okay.
And then you're going to have private mortgage insurance involved with that, but
okay,
it's still worth it holding onto your assets if that's where you're looking to go. So.
Sure. So you can get into a home for as low as 3 to 5% of that purchase price. You correct, don't have to put down 20%, which I think is a huge unknown just for people who have never purchased a home before.
Yep.
So a lot of people, with the way the market's been in the last 2-3 years, is there's been a lot of volatility, and I've heard over and over again for 2 to 3 years that people want to wait to get back in the market. Mm-hmm. They want to wait for purchase prices to come down. They want to wait for interest rates to come down. What do you think about this strategy?
I don't necessarily agree with it, and people are going to say, well, you're involved in the business, so why would you agree with it? But here's the rationale. Back in 2008, when the market crashed, there was a lot of inventory out there.
Right.
Right now, we've kind of got an anomaly in the market where there's not a lot of inventory and interest rates are higher.
Right.
So for you to wait, there's a cost of waiting. So what I tell people is, and it's a cliche, but it's like marry the house and date the interest rate.
Right.
Because you can always refinance and come down, and you still, if you're renting, you're just throwing money away to a landlord. So it's better to own the property.
In order to buy in this market with the way that interest rates are, do you think that the credit application process is more difficult? Are there higher standards which require borrowers to have a high credit score in order to buy?
No, not necessarily. I mean, you can do an FHA loan. We can do credit scores down to 580.
Okay.
So they can be done. There are some caveats to that, but and they do look at documentation and scrutinize it more. But if you're a W-2 pay stub employee, then it's the same old, same old. If you're if you're self-employed, you need a qualified loan officer to help you navigate through the mortgage process.
And is it difficult for someone who's self-employed to get a loan, or what type of requirements? How do you qualify if you're self-employed?
There's a couple different programs out there. There's bank statement loans. There's also, if you run a profitable business, again, if you're dealing with a credible loan officer,
right,
then they're going to be able to analyze the tax returns and give you a good recommendation on which way you should go.
Okay. So pre-qualification versus pre-approval.
Mm-hmm.
It's something that I hear real estate agents talk a lot about.
Correct.
So what's the difference? And which, even as a seller, what are you wanting from your buyers to get? Do you want them to be pre-qualified or pre-approved when you sign that offer from them?
I will always recommend pre-approved. Pre-qualification, the difference is whatever the borrower puts on the application is what we use to qualify them. There's no vetting, so when we vet on our pre-approvals, they're a full underwrite. So except for collateral, which is the appraisal and property address.
Okay.
So they're actually going to provide us with all the documentation. It's going to go into underwriting, and they're going to get a pre-approval commitment. So that's actually gold in a competitive market for a buyer.
So pre-approval comes with a process of verification, whereas
absolutely.
Pre-qualification could be done on the phone.
Yeah, there's no vetting process.
There's no vetting.
Yeah. And as a seller of a house, I wouldn't take one on a pre-qual now.
Yeah. Yeah. And even if I'm a buyer, I would want to know that I can be approved, and I would want to go through that vetting process before I buy a home. So I think it's a win-win to know the difference and ask for that pre-approval rather than pre-qual.
And that's why it's important to do it ahead of time before you start going out and looking and having an agent drive you around.
Yeah. So do you think that when you look at getting a mortgage and when you think about financing a mortgage, is the interest rate, is that the most important factor? Is that what you should look at in securing a mortgage?
It's important, but it's not the most important thing, because interest rate can be determined in a lot of variables. It can be down payment, type of property, and credit score. So the higher the credit score, naturally, the better the rate. So if you're buying a single-family home as opposed to a condo, the single-family home is going to have a better interest rate. You should look at interest rate, but it's not the most important thing. What you should be really interested in is, can you afford the home, and you need to help somebody navigate you through that process as well.
Right. So loan amount's important, right?
Loan amount,
interest
payment,
rate.
what
monthly
you pay
payment.
for taxes. Like right now in Florida, as you know, they're having issues with homeowners insurance. So if you buy an older house that's less expensive than a newer home,
right,
your payment could actually be higher on the older house because of the insurance. So,
Yep. So there's a lot of different factors. So just because, you have a certain interest rate doesn't mean that your monthly payment, your cash flow is going to be X.
Correct.
Interesting. So there's a lot of different factors that go into preventing people from securing mortgages and obtaining financing. Mm-hmm. And so, one of the most recent challenges that I think we've seen in the past couple of years is student loans. Mm-hmm. And there was a forbearance that was just lifted here this past month. Mm-hmm. And now for the last 2 years, students didn't have to make any, because of COVID, didn't have to make any payments, and their loans were forbeared. Yeah. And so we're seeing that now come back, where students are having to make those payments, and they're going back to essentially pre-COVID times.
Correct.
So if a millennial or if even an older student, if they have student loans, how does that factor that into their ability to purchase a home? And does that prevent them from being able to buy?
Well, the guideline is depending on the program. So even during COVID,
Yeah.
we were still counting the student loans, even though there was zero on the credit report as far as the payment went.
Right.
So we were counting either 0.5% or 1% of the student loan balance. So
That's good.
Yeah.
Yeah.
So it really didn't have a major effect on us. So now,
Yeah.
only unless they've renegotiated their payments a lot higher than that 1%, but it's usually not.
Sure.
Okay.
So it sounds like there are opportunities for students or I guess
Oh, absolutely.
graduates
Yeah.
that have student loans to purchase homes if
Yeah.
they have student loans.
Again, I can't stress it enough. You need to sit down with a qualified loan officer and go through all of this, because it is kind of complicated, and you want to do that before you fall in love with a house, not after. So
Okay. Just to kind of wrap things up, so renovation loans, they're complex, right? And so if you've got a property and maybe you don't want to switch houses, but you want to perform some renovations, is it possible to get a loan to pay for those renovations?
it is. There's a few different programs, and actually Cardinal has their own in-house program as well.
Okay.
So let's say you want to add a new bathroom, remodel a bathroom, a kitchen. There are programs that allow you to finance that in.
Good. All right. Well, that's great. Well, Brian, I appreciate you joining us today. We are out of time, but how can people learn a little bit more about Cardinal Financial, as well as get some more questions if they wanted to their answers, more answers to their questions, if they wanted to contact you directly?
Sure. Well, our office is in the Pelican Plaza on A1A and Vero Beach. We are local. My cell phone number is 781-540-1189. And if you just have questions, feel free to give me a call.
All right. Sounds good. I'm Jordan Lulich. This is the Lulich Corner, and thanks for tuning in, and we'll see you next time.